We're heading for a recession. This recession could be more severe. If it's not here already, it's coming very soon. Certainly, first half of 2023. I agree with that. You were talking about narratives, and I always say, reality always wins, but not on day one. The narrative, the narrative can prevail. So right now there are three narratives going on. There's the narrative. There's what Jay Powell thinks.
Yeah.
And we know what he thinks. I always say forecasting the Fed is the easiest thing I do because they tell you what they're going to do. You just have to listen and believe them. So I don't need to recite it, but it's, he's going to 50 basis points in December, probably 50 basis points on February 1st, maybe 25 basis points on March 22nd. They're going to keep raising rates. They're going to look for the terminal rate. I don't know what it is because Jay Powell doesn't know what it is. No one knows what it is. But it's the Potter-Stewart approach. They'll know it when they see it. So Powell is determined to get there. In my view, he's already past the terminal rate. We're at the terminal rate, and because recession's coming off the top, it's not going to be 2%, next month or anything, but it's coming off the top. So then this brings us to the Wall Street narrative, which is, inflation's off the top, economy's slowing down, Powell's going to pivot. This is the pivot narrative. Probably cut rates by March or April. So that's Jay Powell's narrative. And I'll tell you what drives it. There's a clue. There's a hidden aspect there that is driving it. We'll come back to that. Then the Wall Street is, you probably are at the terminal rate. Inflation is coming down, so you're going to pivot, cut, and Goldilocks, soft landing, buy stocks. My version is that I understand Powell's path exactly. Wall Street's right that he's probably at or near the terminal rate already. Inflation is coming down already. It's going to come down some more. But where Wall Street is wrong is that this is going to be some kind of soft landing. This is going to be a very hard landing and a very severe recession for a lot of other reasons, including the fact that you're trying to destroy supply inflation with demand destruction. It'd be one thing if you were Volcker and the demand is out of control and you need to crush that, but you're trying to control this inflation with this toolkit. The Fed doesn't drill for oil, they don't run farms, they don't drive trucks, they don't do anything on the supply side. So how much demand do you have to destroy to affect the supply side? So just to kind of wrap up here, but here's what's driving Powell. It's called the Volcker mistake. And if you go back to Volcker came in 1979. He immediately set out to destroy inflation, started raising rates, and he did. But we had a recession in 1980, a sharp one, that had nothing to do with Volcker monetary policy rates. Jimmy Carter put some stupid order on credit cards, and Americans put some cap on credit card interest, and Americans stopped using their credit cards. And it was like the pandemic. It was like you shut down the economy. Oh, gee, that was dumb. So they fixed it, and it went back up again. But in the middle of that, Volcker blinked. He lowered rates 7 percentage points in the middle of that 1980 recession. But inflation wasn't dead, and it came roaring back. And then he had to take it up to 20 to finally kill it. And I talked to Volcker about this. He said, yeah, that was a mistake. And Powell knows that history, and he was around too, and he doesn't want to be that guy. He doesn't want to be the guy who blinks early. So while Wall Street's saying, hey, you got it, you're at the terminal rate, inflation's coming down, he's like, that's what they told Volcker. And Volcker pivoted, and it was a major blunder, and it was much more painful to fix it the second time than if he had just persisted in the path. Powell doesn't want to be that guy, so he won't blink, and he will raise rates in December, February, and March, but by then it will be way past the terminal rate. He's already been raising rates into economic weakness. Now he's going to raise them into a recession. I'm a critic of Milton Friedman in some way. He was a great humanitarian. As an economist, I have a few criticisms. One thing he got right that everyone agrees on is that monetary policy acts with a lag, an uncertain lag. Well, I'm sorry, you started raising rates in March. The policy rate on March 1st was 0. Now it's 4.25. It's going to be 4.75 in a couple 10 days or less. And to go from 0 to 4.75 in 8 months, 9 months, that's more than Volcker did. He eventually got much higher, but Powell is determined to avoid this mistake, what I call the Volcker mistake, and he's going to keep raising. Now they will pivot, but it'll be too late. It'll be after the damage is done. I hate to overuse metaphors, but a good one is you have a really beautiful, expensive vase. Somebody knocks it over and it breaks into 5,000 pieces. You're not going to put it back together. You're going to get a new vase. The supply chain is broken. We cannot put it back together. We won't. Neither the U.S., China, or China want to. Inflation can come from two major vectors. One is the supply side, which is called cost push inflation. Costs go up and it gets pushed onto the market and the consumer. The other one is demand pull inflation, which is more psychological. It's driven by consumers. It's like, thinking of buying a new refrigerator. What's the rush? Oh, the price is going up. Well, I better go buy it now because if I wait 6 months, it's going to be 20% more. The inflation is coming from the supply side. It is coming from the supply chain breakdown. The pandemic made it worse. The war in Ukraine made it worse. That's not where it started. I was actually able to trace the roots of this. It started with the Trump tariffs on China in 2018. Now, I don't want to debate tariff policy. I actually happen to think that was a good idea. But what happened next was, so Trump throws the tariffs on like refrigerators and appliances and solar modules. Well, it was applied to everybody, but China made most of it, so it was really aimed at China. So China shoots back. Two largest soybean producers in the world are the United States and Brazil. The biggest consumer is China. They need the protein. They were buying all their soybeans from the United States because we were buying all the stuff from them. Like, well, what can we buy from the United States to balance the deficit a little bit? They will buy the soybeans. And they did. Well, after Trump throws the tariffs on, China sends all the orders to Brazil. That's not a phone call. I mean, you got vessels at sea, you got port logistics, you got farmers who got to increase their capacity, you got to build new facilities in Brazil, and everyone involved. Nobody wants a 6-month deal. They want a 5-year deal or a 3-year deal at least. So all that soybean production is now expanding in Brazil. All the Brazilian soybeans, or not all of them, but a lot of them are going to China. And that's locked in. That's not coming back to the United States anytime soon. So what do the U.S. soybean growers do? Well, they looked around. Hey, the Netherlands, they need soybeans. So we start selling to the Netherlands. But think about what you're doing to transportation lanes. You're scrambling them. Yeah. You say, okay, you're not going out of Port of LA, you're going out of Houston or Port of Savannah or Port Elizabeth. And Brazil, you get better fix things up in Rio or wherever they were coming out of, Buenos Aires maybe, to get those to China, and can you go through the Panama Canal or not? But this was a major reshuffling. And it was the beginning, and then the tariffs went back and forth. They escalated to $500 billion on each side. But this really broke the supply chain. But of course, the pandemic made it worse. And China still got zero COVID. They say they don't, but we'll do the math there. It's going to come back. 1.4 billion people. If they decide to let COVID rip, so here's another Wall Street scam, not scam, but get your pom-poms out. So Beijing, and I spent a lot of time in China and I dealt with Communist Party officials. Beijing is now saying to the provinces and the cities, you got to ease up a little bit. We got social unrest. If you have COVID, you can stay home. We're not going to put a steel bolt in front of your door and all that stuff, okay? So Wall Street's saying, hey, zero COVID's over. China's going to boom, buy Chinese stocks, right? No. In my view, the United States has been in a depression since 2007. And Japan has been in a depression since 1989, 1990. And that falls out of people not understanding the definition of a depression. So we all know what a recession is, except Janet Yellen. Two consecutive quarters of declining GDP is a recession. I know there's some bells and whistles, and the National Bureau of Economic Research has got to weigh in. I get that. But we had 2 consecutive quarters in the first half of 2022, declining GDP. There's your recession. Mild, brief, okay, but that qualifies. And Japan has had 8 recessions since 1990. A depression is different because people say, well, gee, if a recession is 2 consecutive quarters or 3 or 4 consecutive quarters of declining GDP, and a depression sounds worse, that must be 10 quarters of declining GDP. But that's not the definition. I use John Maynard Keynes' definition. He said it's a sustained period of below trend growth in which you neither collapse nor return to trend. So it's depressed growth. And the metric there is, if you're capable as a society, and a mature, advanced industrial economy should be, of 3.5% growth or even 4% growth on occasion, and you're running at 2, that's a depression. Now, you don't have a technical recession, but that gap, that delta between 4 and 2, of course, it gets wider. This is lost wealth. We're now into like $7, $8, $9 trillion of lost wealth. Average annual growth from 2009, when that last recession, whatever it was, recession was over, to 2019, just before the pandemic, so 11-year period, was 2.2%. But we should have been running 3.5, or maybe even higher at times. So I would say that's a depression because it's depressed growth under Keynes' definition. So we're still in that. And by the way, the Great Depression from 1929 to 1940 had 2 technical recessions. 1929 to 1932 was a technical recession. 1937, 1938 was a technical recession. But 1933 to 1936, the U.S. economy grew very well. The stock market rallied in the middle of the Great Depression, but that's my point. The problem was it rallied, but we were from such a low level that it's like you fell in a 100-foot hole and you climbed out 50 feet. Okay, nice going, but you still got 50 feet to go.